Learning objective 2 introduces us to bonds. So bonds are basically loans from investors. A lot of people are very familiar with the stock market since the stock market is talked about quite frequently in the news. But the bond market is really just as important. Both the stock market and the bond market are where investors and businesses and governments meet to raise money. Bonds are simply long-term loans from investors. So basically, they are long-term notes. They're like a long-term notes payable. Um, they are interest-bearing, and we are going to focus on corporate bonds, which are where corporations go to the bond market to lend, to get loans from investors. But the bond market is quite large. The United States government is clearly a very big player in the bond market. Um, when we say we have all this national debt, most of it is basically from the government borrowing money from investors, um, and that's basically what all that debt is, all the bonds that the government has issued over time. Um, the state and local governments are also very large players in the bond market as well. When New York put up our lovely new, what was supposed to be a Tappan Zee Bridge, is now Mario Como Bridge. Well, I mean, bridges are a lot of money, billions and billions of dollars. Where did New York get that money from? They went to the bond market and they asked investors to lend them the money and let them pay back over time. With interest, of course. So the bond market's extremely important. But what we have to remember, if you are asked about what a bond is, it's simply a loan from investors. Bonds are sold in denominations of 1,000. So if a company sells one bond is $1,000 loan. Okay, so they're getting $1,000 for one bond. So that's what they mean by small denominations. Okay. So again, when a corporation is issuing bonds, the word issue is to sell. When they're selling bonds, they're basically borrowing money from investors. The person who lends the money is the bondholder. They're the ones who are making the investment. They're the ones who are going to be getting interest over time. And that's how bonds work. So let's do a quick review of how bonds would work. So say you're an investor and you lend $1,000 to a business, a corporation, and it's 2021, right? Most corporate bonds are for periods of time like 10 years, up to 20 years or so. So that means that the bond is going to be paid back in 2031. So what does that mean? Is that you will get your $1,000 back 10 years from now. Well, that's a long time to wait, right? Well, that's because in the meantime, every 6 months, they're paying interest on the bond. So these little lines are supposed to be somewhat 6-month intervals in which the corporation is sending you interest on the bond. So let's say, let's make believe, for the sake of the example here, that it's a 5% bond. It's a coupon or interest rate of 5%. That means that every year, the company is promising to pay you $50 every year on this $1,000 loan, except they break it into 2 payments. They will give you $25 in 6 months and the other $25 6 months down the road. And they do that every single period of time until the bond is matured, which means they have to give $1,000 back to the lender, the bondholder, with the very last payment of interest. So what's in it for the bondholder, as you see, is they're going to be getting this stream of interest payments over a long period of time. And that's what's attractive to bondholders in the bond market is they're looking for that stream of income over many, many years. And that's the thing. So that's basically some of the basics of how bonds work in that regard. And again, one bond is a $1,000 loan. In terms of how bonds are classified, there are two basic classifications of bonds. There are some bonds that we are called secured bonds. And a secured bond basically is the company who's borrowing money has pledged collateral for the loan. So, for example, if Tesla borrows money because it wants to put up a new factory and need to borrow money to buy equipment and for their assembly line, if they have a secured bond, what they're saying is, look, we are pledging the equipment in case we don't pay back the loan, in case we can't pay back the loan. The lenders, the bondholders, are secure in the fact that then they will own that equipment. That's the collateral. Secured bonds are simply another word of secured loans. If you look at a secured loan that you have entered into in your lifetime, or you will, would be a car loan, for example. Anytime you enter into a car loan, that's a secured loan. Basically, you have pledged the car as collateral in exchange for the loan. And if you do not pay back the loan, you have given the lender the right to take possession of the car and sell it. So that's what a repossession is. Well, bonds, a secured bond works the same way. A corporation has, in essence, pledged the asset for the loan. So in case they don't pay back the loan, which is the bondholders take possession of the asset. Thus, they can sell the asset and get their money back. An unsecured bond is an unsecured loan, okay? And this is a very important thing to understand. How are unsecured loans and unsecured bonds work? Well, basically, you personally have a lot of unsecured loans. For example, a credit card loan is an unsecured loan. When you get a credit card, you're getting a credit card based on your general credit profile, right? Your reputation and your history of keeping your word and paying back loans. So that's an unsecured loan. Well, that's basically what an unsecured bond is. It's a corporation who borrows money based on their general reputation as a borrower, okay? So you and I have credit, we have credit scores. Corporations have something called credit ratings. And so there are many different companies. You probably have heard of a few like Standard & Poor's, Moody's, Fitch is another one. These are companies that basically perform financial analysis for investors and create credit ratings for corporations. The highest credit rating would be a AAA credit rating, okay? And then they go down from there. There's AA, it sounds like a battery family, but it's not. There's single A, and then it goes to triple B, double B, B gets to C. After C, it goes to D, and nobody wants that. So basically, a credit rating for a corporation, if a corporation has a AAA credit rating, their general profile is that they have their excellent reputation of paying back lenders. So if an investor wants to lend their money to a corporation that has a AAA credit rating, it's pretty much almost as guaranteed as can be that they're going to get their money back and they're going to get paid interest along the way. So clearly that's important. But as you go further down in the credit rating, the risk of lending to the for an investor goes up, because a corporation that is say triple B or even double B is financially more risky than a corporation who's rated AAA or AA. They're just riskier, right? Their reputation for paying back loans and handling credit is riskier. That's why they have a lower credit rating, or credit rating in this case. Well, will investors still still lend money to them? Yes, they will. Well, the price of money is interest rate. So whenever you see an interest rate, you'll know that interest rates is simply the price of a loan. So if you're looking to borrow money, you want to know what the interest rate is. Well, because the interest rate is the price of the loan. They'll let you borrow money at this price, at this percentage. The percentage is the price. So that's how you should look at it. So as corporations get more risky, in other words, they go down in rating, the interest rate that investors want go up. Because if they're taking more risk, they want more return. They want a higher rating. They want a higher percentage back for the rating. And so that's basically how unsecured bonds would work. A D, any company that has a D for a rating, that means default. And to default means that they've stopped paying on the loan. They stopped paying interest on the loan, or they're unable to pay the loan back, so they've stopped paying. So that's D. Default is simply you stop paying the loan. You're in default. So those are general classifications. These are very, very important to understand. Again, a secured bond is a bond backed by an asset. An unsecured bond is a bond simply backed by the general credit profile of the corporation. Bonds have different features. I know they put this as a type of bond, but it's more like a feature, because not all bonds have these features. The first feature is is a conversion feature. A convertible bond basically is a bond that gives the bond holder the option to convert their bond into shares of common stock. Okay. So the convertible feature is simply from going from being a bondholder to convert that into being a stockholder. And that's basically it. Once the bondholder converts, they are a stockholder. They're no longer a bondholder. They're not going to get the bond ends. The payment of the bond was with shares of common stock. That's the payback. You forfeit the interest on that. You forfeit the $1,000 on every bond you bought. Instead, you're getting shares of stock as payment for that loan, and it's done. A callable bond is a bond that can be bought back, called, by the company, meaning that they can pay it off early. Well, this is good for the company. It's not necessarily good for the lender, for the bondholder. Usually, what is the motivation to pay a loan back early? Oftentimes, it's the loan costs a lot, and you want to pay it off early. Well, if you're a bondholder, you're getting a very high interest rate. You're very happy. You don't want them to pay the loan early, because you're collecting lots of interest on this. It's a good deal for you. But the company decides that in one way, shape, or form, it's better to pay it early. So they call it. And a call feature is an option for the company, not an option for the bondholder. Convertible is an option for the bondholder, not the company. So those are just some features there. So again, a bond is sold from the company to the investor. So the selling is called issuing. Okay. And what do you get as an investor? You get an official bond certificate, which you'll see what it looks like on the next slide, issued directly to you as proof of ownership of the bond. Okay. The face value of the bond is the amount of money that the loan was for that's going to be paid back at the maturity. So the maturity date is the due date. Maturity date is the due date. Right? So maturity date, when the final payment is made. And then, of course, all bonds have interest rates. The interest rates are part of the contract. This is what they promise to pay you. It's a contractual interest rate. And so that's stated as an annual rate. We often call the contractual interest rate the coupon or the stated rate. Okay. This is what a bond looks like, an actual certificate, what it looks like. Again, it'll have the amount of the loan. The face value is $5,000. So a $5,000 loan is the same as 5 bonds, because each bond is $1,000. Right? The issuer of the bond is the company borrowing the money. So in this case, it's International Minerals and Chemical Corporation. They're the issuer of the bonds because they're the ones who are borrowing money from the bondholders. Okay. The contractual interest rate is going to be stated. This is a yearly interest rate. Okay. So 5.75% per $1,000 loan. So each $1,000 loan is going to pay $57.50 of interest per year, per 1,000. So multiply that by 5. That's what this person is collecting in interest every year. Okay, you would be listed right here. It's a specimen here. All your information would be listed here if you were the bondholder. Okay. And then, of course, it has a maturity date, the date in which it's going to be paid back. Okay. Now, this is a very interesting bond because, so a debenture bond is simply a bond, it's an unsecured bond. So it's based on credit rating of the company. But this is interesting because this bond has a sinking fund feature. And this sinking fund feature is important to bondholders because what the bondholder is getting is a promise for the company that they're going to put a little bit of money aside in a special fund, the sinking fund, every year to to show that they're able to pay the loan back, pay the bond back when it's due. So a sinking fund is just simply a nice little thing to tell investors that, hey, we're going to create the sinking fund, which means we're going to put money aside every year to pay the bond back when it's due. So you don't have to worry about us paying it back. That sinking fund provision is telling you we're serious about paying you back. We're not that risky. Give us the loan. Give us the loan. So that's basically the purpose of a sinking fund. So bonds are sold on the market, right? Just like stocks are sold on the market. So investors are paying basically 100% of the value of a new bond. Each bond is $1,000. That's the face value of a bond, is 1,000. And when bonds first are issued, without any changes in any interest rates, they would be $1,000 each. However, markets change because interest rates change. Okay, the market rate of interest changes every single day on the stock market and on the bond market. If you watch the business news, they'll tell you about how interest rates are changing. Right, the 10-year note is increasing. We want more inflation. Inflation and interest rates go together. So more inflation, higher interest rates. So interest rates change every single day as the markets change. And so this particular bond has a stated rate. Say it's 3%. Right? Well, if long-term rates are less than 3%, because investors can now get 2% in the market, this 3% bond is going to look really attractive, right? Because you got a whole bunch of people investing at 2%, and this bond is being offered at 3%. Like, wow, I want to buy that bond. Well, guess what? So does everybody else. And so what that means is people are willing to pay more than 100% of the price of the bond to get it. And so bond prices can be more than 100% of the value of the bond, or on the other hand, they can be less than 100% of the value of the bond. So for example, this is a 3% bond, and then all of a sudden interest rates skyrocket to 4%, which means investors can now invest their money at 4%. This bond has been issued at 3%. Who the hell wants a 3% bond when you can get 4% in the market? Well, how do you sell a 3% bond? Well, you sell it for less than 100% of its value. And so the market prices of bonds fluctuate with interest rates, as you'll see. But how do we actually know what the value of a bond will be 20 years from the time it's being issued? So if we issued a bond in 2017, it's a 20-year bond. It's not due until 2037. How do we find, in essence, the present value of the bond? Well, we use a method of discounting. Present value is simply discounting. Future value is compounding. They're just opposites. So this chapter shows you how that's done, okay? Using a present value chart. This is how they would calculate the market price of the bonds that they have for sale. So this company, Acropolis Company, on January the 1st, they want to sell $100,000 worth of bonds. The bonds pay a 9% coupon. That's a very high rate, right? And they're going to mature in 5 years. The interest in this case is only going to be paid annually. That's not really how they're done. They're done semi-annually. But in this case, it's to make it simpler, they're going to pay interest annually. So 9% interest on $100,000 is $9,000 every single year. So every single year, they're coughing up $9,000 in interest every single year for 5 years. At the end of the 5th year, they're going to pay their $100,000 loan back as well. So using the present value table, because we're starting from today, January 1st, 2017, what is the market value of $100,000? Well, $100,000 is going to be paid in 5 years at 9%. So there's a present value factor that says $100,000 received in 5 years is worth $64,000 today. What about this stream of $9,000 payments? Well, you've got $9,000 payments every year for 5 years. But the present value of that $9,000 every year for 5 years is $35,000. So the actual market value of the bonds, when you look at the present value of this, is $100,000. And that's basically how they know they're going to market to 100% of its value. And that's basically what this chapter introduces. The most important part of learning objective 2 is the terminology, not so much how the present value is done, although that's there. I'm not going to emphasize it. You get a little bit of questions on it, but not a lot. So here are 5 statements in which we have to see it's true or false. So secured bonds have assets pledged as collateral. Yes, that's what makes them secure to the lender, that if they can't pay back the loan, I can take ownership of the asset. That's what they've done. That's what you do when you get a house loan, a mortgage. That's what you do. That's what you agree to when you get a car loan. You've agreed to put that asset as collateral. You can't pay back the loan, they take the car. They take the house. That's a secured loan. That's a secured bond in this case. A callable bond can be redeemed by the issuing company. Yes, it can be paid early. So to redeem is to pay it back, right? You're redeeming it early. The contractual interest rate is the rate investors demand for loaning the funds. No, investors have very different demands based on the credit rating of a company, et cetera. The contractual rate is the contractual rate. Investors either going to want it or they're not going to want it. The face value is the amount of the principal that must be repaid on the maturity date. Yes, that is true. The market price of the bond is equal to its maturity value. No. The market price is going to fluctuate as bonds are traded every day on the bond market, just like stocks are traded every day on the stock market. Okay, there was a lot there to unpack. I'll take a break with you. So welcome to Learning Objective 3. And Learning Objective 3 basically is the accounting on all of this stuff, okay? How do we actually do the accounting for bonds, bond transactions, okay? So if we're a corporation and we need to do journal entries every time we sell a bond, which means we issue a bond, and every time we redeem a bond, which is we buy it back, okay? We also have to do journal entries, believe it or not, when bondholders convert their bonds into common stock, because then we have less liabilities, but we have more stockholders. Okay. Bonds are going to be sold at either their 100% face value, or they'll be sold either at a discount, which means less than 100% of their value, or they're going to be sold at a premium, which means more than 100% of their value. 100% of the value is that $1,000 per bond. That's their face value, $1,000. If you're paying more than that, if they're selling it for more than that because investors want it, they're willing to pay more than $1,000 for a bond, that's a premium. But if investors aren't really interested in it and the price goes down less than 100% of their value, less than $1,000 for a bond, it's a discount. Bond prices are simply percentages of that face value. And that's going to be important to know. Okay, so let's do this. Here's an illustration about issuing bonds and what we have to do to record the sale. So we issue 100 5-year, 10%, $1,000 bonds. So again, a little bit of math, $100,000 bonds, okay? So we're gonna get $100,000 in cash, but we have to record that we have $100,000 in bonds payable. They were bought at 100% of the face value, so that's why it's 100% of this, okay? 100% of 100,000. Okay. What would happen here is if we sold it in January and we came to the end of the year, because we haven't paid our interest until the following January 1st, for example, we would have to make an accrued interest adjustment, okay, for $100,000 bonds at 10% for the year, okay, which means on December 31st, we would be able to expense $10,000 of interest and set up a payable, although this payable is going to be paid the next day. Doesn't matter, right? Because it's a different accounting period. So we issued the bonds in 2017, but we haven't paid the interest yet until the 1st of January 2018. So we're going to claim the interest expense for that year, set up the payable. So what happens when they actually pay the interest the next day? They're simply going to take the payable away with the debit and show that they pay that in cash. So what happens when a company does go to the market to sell their bonds? Do they always get 100% of the value? No. They don't always get issued at what we call par. Par is 100% of the value. Why? Because interest rates on the market change every day. They fluctuate up, they fluctuate down. So depending on what your interest rate is on your bond, it's going to change. So this particular example gives you a bond that's issued at 10%. So that's the rate that's on the bond is 10%. If when they sell it to investors, the market rate is also 10%, they will get 100% of the value of the bond. So a $1,000 bond will sell for $1,000. Okay. However, if by the time they get to the market, the interest rates have now dropped to 8%, well, and that means that at the current time, investors can get 8% on their money. You have offered them a chance to get 10% on their money. They are going to want to buy your bonds. The problem is everybody wants to buy them. And you know what happens when everybody wants to buy something? The price goes up. So that means they're paying more than 100% of the bond premium, the bond price. They're paying more than $1,000 for the $1,000 bond. And thus, they're going to be sold at a premium. Okay, that's basically what that is. Which means the company's going to collect more than 100% of the value of the bond. However, these bonds are issued at 10%, and the market has changed. The market rate is now 12%. So that means investors can come into the market today and get 12% on their money. Why would they want to buy your measly 10% bond? Well, they wouldn't. Well, how do you sell a 10% bond when everybody can get 12%? Well, you have to discount your bond. In other words, you sell it for less than 100% of the value, or you sell it at a discount. Okay. So that's the idea between a premium, which means you're selling it for more than 100% of the face value, which means a $1,000 bond is going to sell for more than $1,000. Or if interest rates have gone up and your bond is not very attractive, to make it more attractive, you're going to need to lower that price, which means you're selling it at a discount, which means you're selling a $1,000 bond for less than $1,000. Okay. So how does it look when you actually go and issue your bonds at a discount? Okay. So assume that it's January the 1st and your company, Candlestick, is selling $100,000 worth of bonds. They're 10% 5-year bonds, but they're only selling them at 98% of the face value, not 100%. That's what the discount is. Okay. The interest isn't payable till the following January 1st. So how do we record this if they're selling $100,000 worth of bonds at only 98% of their value? Well, they're only going to be collecting $98,000 of cash. They're going to have to record $2,000 as a discount on those bonds that show up here, and they're going to show bonds payable of $100,000. So they still owe $100,000 worth on their bonds. That's the loan. However, they're only collecting $98,000 of cash for that loan. So that discount, in essence, becomes part of the cost of the loan, as you'll see. How does it show up on the balance sheet? Well, the discount on bonds payable acts like a contra liability account. Bonds payable of $100,000, that's what they actually owe. However, they had to accept a discount. They were only able to sell it at 98% of the value. So the $2,000 discount needs to be shown, and the true value of the bonds will show up as $98,000. Okay. So in essence, you're borrowing $98,000 and paying back $100,000, which means that when you sell your bonds below the face value, the cost of borrowing goes up. Okay. Because yes, you borrowed $98,000, but guess what? You're going to need to pay back $100,000. So that increases your cost of borrowing money. Okay. So that's important to know about a discount. So here they have a chart on just what we were talking about here on the total costs here. This particular bond, again, $100,000 bond at 10% a year, right? That's $10,000 per year for 5 years. That's $50,000. Then you have to, in essence, say, well, it's going to cost me another $2,000 because I couldn't sell it for full face value. So I'm actually need to pay $52,000 over 5 years to borrow $100,000 today. That's going to be the cost in terms of interest. In terms of how this is another way that they can look at it, right? You have $100,000 of loans to pay back. You're paying interest of $10,000 a year for 5 years. So the cash that's going to be paid back to bondholders is the cost of the loan plus the interest. You raised $98,000 in cash. So the difference is what your cost is. It's just another way of looking at it. What do you do with the discount? What do you do with that extra $2,000? How do you show it as part of the additional costs that you have? Well, bonds go through a process of amortization, okay? And we will simply amortize that in each period. So in this case, the $2,000 over the 5 years will be portioned out accordingly, okay? Until the balance declines to zero. So in this case, oh, this is another one. In this case, we're issuing bonds at a premium. In other words, we are selling the bonds higher than their value, higher than 100% of their value. So we sell them at 102 rather than 100. 100% of their value, that's 102% of their value. So that means when we sell $100,000 worth of bonds, we're actually collecting $102,000 worth of cash. Sounds like we're making money, right? Well, we still have $100,000 worth of bonds, but now we enjoy the fact that the premium is going to help lower the cost of the loan. Discounts increase the cost of loans. Premiums decrease the cost of borrowing money, okay, from investors. So they work the opposite. So in this case here, they are going to show that they are going to add a premium to their bonds to show the total value is 102. Well, because when you sell bonds at a more than their face value, the cost of borrowing is lower. And that's all it does, lowers the cost. And again, premiums will go through that amortization process as well. But this is how it looks in terms of what it's actually costing, right? It's $10,000 a year for 5 years of interest, $50,000 of interest, but they were able to get a premium. They collected $2,000 more for selling $100,000. So that's going to lower the cost of the loan to $48,000, okay, for interest. To look at it in a broader way, they borrowed $100,000 that they have to pay back. They have to pay back 5 years of $10,000 interest payments. So this whole loan is going to cost them $150,000 in total. They received $102,000 in cash because they were able to sell it at a premium. So the total cost of the loan is going to be $48,000. Okay. Again, bonds that are sold either at a premium or a discount, the difference is going to be expensed through amortization. Amortization expense works like straight line depreciation works. Okay, same. So not too much to worry about there. So here is an example of a bond issuance where you have this giant corporation, which makes perfect sense. They issue $200,000 worth of bonds, but they only get $89,000 worth of cash. So clearly they sold that for less than what they wanted, which is the discount. Prepare the journal entry for the issuance of the bonds. That's part A. And part B, show how the bonds will be reported on the balance sheet. Okay. So part A is they received $189,000 worth of cash to sell $200,000 worth of bonds. The difference is going to be the discount. Okay. The discount is going to mean that it's going to cost them more to borrow money. That's all. The second thing is they would show the $200,000 worth of bonds payable minus the 11,000 in premium discount rather on the bonds, showing their value is 198,000. Why do I say 198? 189. What happens when they pay the bonds back? Well, that's a redemption. That's a redemption. Redemption, something they're paying it back. So normally speaking, if you had $100,000 worth of bonds, when you actually pay them back, whatever date they've matured, you would debit your bonds payable, that lowers the liability, and you'd credit cash. That's how it would work. Okay. Sometimes, like I said, there's a call feature. So sometimes a company retires the bond before they mature. They mature. In which case, the bond will have a value on the balance sheet that has to be eliminated. That's called a carrying value. They have to record the cash payment. And based on how much cash, what the carrying value is and what the cash paid is, they're going to either recognize a gain or a loss when they pay it back that has to be recorded. Okay. So the carrying value of a bond is the face value of the bond minus any unamortized discount, or if they were sold at a premium, plus any unamortized bond premium. Okay, so it's going to be one or the other. If they were sold at a discount, we're going to subtract this out. If they were sold at a premium, we're going to add this in. And this is an illustration of how that works. So it's the end of the fourth period. Candlestick has sold its bonds at a premium, and they retire the bonds at 103. So basically, to retire the bond is to redeem the bond. They're going to pay it back early, okay, after they've paid the interest. Assuming the carrying value of the bonds is $100,400, how would Candlestick record the redemption? All right, so again, they recorded it, they're redeeming at 103. So that means that they are going to show $100,000 of bonds have been paid. They're going to show they are paid off the $400 of a premium. They're going to collect $103,000 in cash. So the difference between the carrying value and the cash value is going to show up in this case as a loss, because they've collected more cash than what they've actually, what the bonds are actually worth. And so in this case, the redemption is going to show up in this case as a loss for them, believe it or not. And so we come to the end of learning objective 3 and these redemptions. And you might think y'all need some redemption after this weekend, but you'll have a lot of fun, no doubt. Again, basics are really stressed here. I'm not trying to make anybody an expert, just to get everybody up to speed. So R&B, which is actually very good music to listen to while you're doing accounting, they issued $500,000 10-year bonds at a discount. Prior to the maturity, the carrying value of the bonds was $496. They redeemed the bonds at 98% of the value. So what's the solution here? Prepare the entry. Prepare the entry. Well, again, they paid $490,000 in cash to redeem. That's 98% of $500,000. That's $490,000. So 500,000 times 0.98 or 98%. You get that much. Okay. The carrying value on the books is $496. So by paying it off early, they're going to actually get a gain on their redemption. So they will show this basically by debiting their bonds payable to show they paid the bonds back, crediting cash by the 490. They had to do two things in this case. They had to show the discount on the bonds, and they had to show the gain on the bond redemption as well. So there's some things that you're going to be trying here that may not make a whole lot of sense at first. Um, Work through them a little bit, give it some time to sink in, and we will review everything that you need to go over for sure when I see you next time. In the meantime, are there any questions?